AI market bubble will pop when blank. Today we're going to read this article by Brett Jensen, and we're going to hit on a really hot topic right now, the AI bubble. Is it fact or is it fiction? And we're going to go through a bunch of key points that he lists out here. I'll react to them and let you know my opinion on what I think, and just see. It's super hot topic right now, whether this AI bubble is real, whether this is just taking off, whether this is another internet bubble in the early 2000s. There's a lot of moving parts here, but let's just take a look here. It's impossible to predict the future, so this is all just kind of speculation, but it is fun to dive into the details and see what's really going on and see if we can, I don't know, make our best guess or make an opinion on the state of the AI bubble and market and see what's happening right now. All right, the key thing here in the summary is saying the article below discusses several of the potential triggers in detail and concludes with the most likely event that will result in a bear market following the AI boom. So let's take a dive into some of those things. We start out with saying the market advanced across the board in the full first trading week of 2016. Encouragingly, the rally was led by the small cap Russell 2000, which rose just over 3.5% last week. This is an encouraging sign for the new year, given how narrow the stock market rally has been over the past 3+ years now. And we get a snippet there of the NVIDIA stock chart and how the growth is kind of capped out here in the last, I don't know, six months there. Most of the gains in the market over that time have been powered by the Magnificent Seven since ChatGPT debuted in November 22. As a result, NVIDIA Corporation has an approximate market of $4.5 trillion. So it should be kind of familiar, but market cap, total value of the outstanding stock at market value. This is roughly the size of Germany's annual GDP, the largest economy in Europe, to put that in perspective. And that's just a wild number. I mean, we haven't seen anything like that ever. So it's incredible how high their stock is valued right now. And obviously, because there is a lot of AI hype, and AI is very powerful, and the growth is right now valued at an insane value, 4.5 trillion, the size of Germany's GDP. Passive investing, which accounts for roughly 60% of market volume, has played a part in this divergence. Just under 15% of every dollar invested in a passive index fund is going to just two stocks in the market, NVIDIA and Microsoft Corporation. So this also is a staggering number, and it's something you don't really notice until you start looking at the mutual funds that you're investing in, and maybe your 401k or your IRA. When I was making my elections for the 401k plan at my company, I'm a nerd, a finance guy, CPA, so I was analyzing each of the funds, and I was looking up the stocks that make up each of the funds. And it is mind-boggling how many of the mutual funds that are carrying, even though it's diversified, if it's a blue chip mutual fund or a growth mutual fund, so many of these overlapping funds are carrying majority NVIDIA and majority Microsoft, a lot of big S&P 500 companies. And so I'm not surprised by this 15%. Of 15% of every dollar is going into just two stocks. It's incredible. And you think there's still some diversification there. You're not putting all your eggs in one basket, but if you took a look at your mutual funds and what you're actually investing in, if you have any passive index funds, ETFs, you'd really be surprised how heavily those are stacked in these two companies, and especially different mutual funds. You'd think that they were completely diversified, but a lot of these still carry similar stocks. And that's why you see such a high percentage. There's 15%. And this chart's a really, really good thing to look at too. So annual earnings growth from the largest Mag 7, and then the remaining 493 stocks in the S&P. The Mag 7 stocks, huge returns. We're looking at 22, 36, 23, 23, 18, as opposed to a negative 3% decline, and then 5% growth, 7, 11, 12. So at S&P 500, that's I can't remember if it's broken 7,000 or not as of the time I'm recording this, but a huge push from these Mag 7 companies, which are the ones really heavily leaning into this AI hype and AI growth. So, man, if something happens there, the S&P is, I don't want to say inflated, but it is burning and pushing a lot because of these largest seven, Mag 7 stocks here. In addition, there's been very little profit growth from the S&P 493 since 2023, roughly 3% annually over the past 3 years. That is projected to rise significantly in 2026 and 2027, which hopefully helps broaden the rally within equities. Meanwhile, the Magnificent Seven keeps churning out 20% plus EPS growth, which is what we were just talking about in that chart up there. I agree with Howard Marks, co-founder of Oaktree Capital Management, recent observation that the AI revolution will travel the same road as every other technology paradigm shift before it, whether it be electrification, the railroads, the invention of the automobile, or the birth of the internet. Eventually the bubble will pop, pushing equities into a bear market. We get another chart here. US ratio of total market cap over GDP. So total market value of the stock market over GDP. And you can see this chart, we're sitting at like 224%, which very high valuation. But again, is the opportunity there? Is AI going to push GDP up subsequently? I don't know. So what is the most likely trigger that will deflate the AI bubble? Well, based on history, it is unlikely to be valuations, even as the market is rarefied air, based on numerous valuation metrics. I feel the AI revolution is tracking closely to the last major global technology paradigm shift back at the end of the 20th century. And that's a good point too. Just because we think things are overvalued right now, there's a good indicator in the Buffett indicator saying that a stat similar to this, market cap over GDP, that things are extremely overvalued right now, and it's just bonkers. But that's not going to trigger the bubble to pop. The fire will keep burning for a long time. The Shiller PE ratio too is a really, really good one. So it's like an inflation adjusted price to earnings ratio multiple. And right now we're sitting at around 40, which we haven't been at since 2000. We were really close to 40 in around COVID. Oh, actually, yeah, right at COVID there. And then 2000s. 2008 it was even inflated. The old saying was around 20 was a good average, and if we got above that things were headed maybe towards a downturn or recession. But with the internet and efficiency increasing at a rapid pace, we don't know that 20 is really a good measure anymore. Okay, being the internet boom, one must recall that Fed Chairman Greenspan famously stated that equities were demonstrating irrational exuberance late in 1996. The bubble would not burst, however, until more than 3 years later. It should also be noted that valuations have been elevated from a historical perspective for at least 18 months now. So it almost seems like the insane valuations can be a precursor, can maybe be a predictor of an upcoming downturn. But again, if you said that over the last 10 years, the market's been burning like crazy, and if you've been calling for a bear market since 2014, I don't know, you would have missed out on a lot of gains too. So again, this prediction market and looking into the crystal ball it's not perfect science, but these are super interesting trends to look at. Therefore, I don't think extreme valuation readings will be the cause of the next bear market. Okay, so we're saying even though these might be a sign, we don't think this will be the author, Brett Jensen, doesn't think this will be the reason. However, they will make the downturn when it occurs that much more painful for investors. It is becoming increasingly obvious that new data center demand will be a huge challenge for the current national electricity grid. A Morgan Stanley study projected new data centers will require an additional 72 gigawatts of electrical generation capacity by 2028, of which some 25 gigawatts are under construction. The gap in that need output is over 40 AP1000 nuclear reactors from Cameco's Westinghouse, it should be noted. So here he's bringing up our next issue, right? Besides valuations is the energy problem. Potential shortfall of 47 gigawatts. Pretty crazy. And these data centers are going left and right here. I live in Fort Wayne, Indiana, and we've got going one up. And they're everywhere. They're going up everywhere, and they're going to pull a ton of electricity. They're going to use a bunch of water too for cooling. So this is something totally to keep in mind. And talks here a little about rising electricity costs and how that's going to keep pumping up the cost of these things. And some, it says here, some jurisdictions are considered charging higher rates to these data centers. And this is just one factor. It says that could trigger the bubble to pop. I don't know that this is the thing that pushes it over the edge either, and the author agrees with that as well. And then here we have something interesting too, the depreciation schedules, which has been kind of in the news the last couple of months, 2 or 3 months. It says, then we have the subject of mundane depreciation schedules. Mundane's a good word because this is not really exciting. Tech giants are increasingly moving to depreciating key data center components like GPU chips from NVIDIA Corporation over a 5 to 6 year life cycle. Unfortunately, most of these chips that are operating in a 24/7 capacity in a data center will have a useful life of 2 to 3 years. Even if they don't burn out that fast, most major data center providers will want to upgrade their chipsets as new. Improved versions become available every 2 or 3 years. And this is a really good point. I'm not so worried much about the depreciation expense and stuff. That's kind of, as an accountant, that's kind of silly to me because most analysts and stuff don't really care. They're usually using numbers that peel out depreciation, like EBITDA, earnings before interest, taxes, depreciation, amortization. And the reason you pull that out is because it's a non-cash expense, right? Even if you're paying for these assets up front, the depreciation expense is just an accounting concept, right? So the cash has already been spent. This is more of a cash problem to me. Are they going to be dishing out cash every 2 or 3 years on new GPU chips for these AI initiatives and data centers? If that's the case, that is going to be a lot more cash than replacing these every 5 to 6 years. And maybe they'll be bringing in the newest chips and using the older chips for other things, other less demanding tasks. And we'll see about that. And then he also starts to dive into tech investment here. Another major question around whether the AI revolution can be sustained is whether AI-related revenues will grow quickly enough to justify the massive investment tech giants are making to build out AI infrastructure. A much quoted September Bain and Company report projected that AI-related revenues will need to reach $2 trillion cumulatively to support the current level of AI-related investment. And this is where I think we're finally starting to get to some real ideas and to some real concerns. Is the revenue going to match all these CapEx expenditures? So we're looking at a total between these companies of $400 billion annualized in capital, and this is going to be like data centers and building out and research and development. Then compared to that, we have revenue projections. And it looks like by 2030 it's projecting close to $400 billion of revenue from the AI development. I think specifically AI cloud products and services. This is from Raymond James. Industry will be Raymond James estimates the industry will be some $800 billion short of those needed revenues by 2030. If these projections play out in the coming quarters, years, when will tech giants start to pare back their capital expenditure plans, undermining the economy and markets? One of the linchpins to the massive increase in AI-related tech spending over the past few years has been the vendor financing cycle. This puts the vendor financing cycle by the likes of Cisco, Lucent, Global Crossing, latent internet boom to shame. So it's saying that this vendor financing circle, which we'll touch on in a minute, I want to go back to this cash flow. So I think this is one of the key points about this whole thing is all this CapEx they're spending on all these data centers going up in your town. Is the revenue going to follow this? And right now, whether it's effective or not, whether these AI products are good and they're doing good work, it seems like a lot of companies are jumping on the bandwagon and paying for some of these subscriptions and services. But again, this like Raymond James projection, like if it's still not enough to cover all that investment and CapEx expenditure, I mean, as soon as it runs out of cash, that's when we're going to start to talk about this vendor financing circle, and that's when stuff's going to hit the fan, right? Is when the cash runs dry. And kind of what we saw in 2008, one company files for bankruptcy, then the next, and they're all intertwined. And when they're intertwined like that, it only takes one domino to fall for everything to crumble. So here we go. And this is a great chart. This is just a great chart here. This is just a great chart. So it shows the chart's labeled how NVIDIA and OpenAI fuel the AI money machine, the money machine. And it shows NVIDIA in the middle here, and it shows all these related parties, which it's hard to totally judge them on that because every company has got a bunch of relationships and is intertwined. But to this extent, with all the investment and all the deals and loans and financing, it's bonkers. I'll just look at the Nvidia circle here and all the pink arrows pointing to it. So people are coming to them. Okay, so Nvidia is getting hardware, software from all these different companies. And then the blue arrows going out are investment. So they're receiving equipment from these companies and then proceeding to invest in those companies. So already now, Nvidia's got a stake in the companies it's receiving hardware, software from, and that kind of does remind you of the Cisco, like, not scandal, but the Cisco, kind of scam, fraudulent dilemma there. And then these dark blue arrows are services. So then Nvidia is also providing services to a bunch of these other companies. And then the same thing's happening with OpenAI, Oracle, all these. So basically, there's just a ton of reliance on each of these companies. And again, this will come down to the revenue and to the cash. Cash is king. If any one of these players goes down, the other companies are taking a big hit. And if enough of those dominoes fall to make a big enough hit, that's a lot of what ifs, and it's silly. But I love talking about this. I love projecting. I love talking about the future. It's really, really neat to see. I hope this doesn't happen. I hope this doesn't crash. I hope the stock market does not wreck. But it's just super interesting to see all this entanglement, and it really reminds me, It really reminds me of 2008. If you've read the book Too Big to Fail, you just don't realize how much all this stuff is intertwined and how much these companies rely on each other. And if one person goes down, if one financing deal goes down, credit markets freeze up. Stuff can go bad really fast. A key driver of this dynamic has been OpenAI. The company has a goal of $15 billion in revenues in financial year 2025. Recent projections have OpenAI burning $8 billion in cash in 2025 and $115 billion cumulatively by 2029. That's a lot of cash they got to keep on hand. The company's franchise product, ChatGPT, is also losing market share at an accelerating pace since Gemini 3 from Google recently debuted on the market. And Anthropic's cloud has overtaken OpenAI in the enterprise market. So not only is OpenAI in the middle of this big thing, but they've also been losing market share from ChatGPT, which is like really the main thing out there for them right now. And you can see generative AI traffic share. 12 months ago, OpenAI pretty dominated. They had about 85-90% probably share, and it's just been quickly losing to Gemini especially, but some of those other ones have gained too. And so now they're looking only at about like a 65% share, I'd say, which is a huge loss in just 1 year. And if this keeps going, again, they need those revenues. If these revenues aren't coming in, the cash dries up. They're not going to be able to make these payments and these financing arrangements, or they won't be able to keep investing in CapEx expenditures. And if that even slows down, that can be enough to worry people and to, I don't know, to send this thing in a different direction. Despite these challenges, OpenAI has committed more than $1.4 trillion to purchase further computing capabilities and capacity from the likes of Oracle and Microsoft. And it says here, what could possibly go wrong? So again, kind of what we were just saying, OpenAI's whole business model is dependent on being able to raise significant amounts of new capital, even greater valuations. And this is a great point. You've got to be able to issue new capital, but like what we were saying earlier, the valuations in the stock market, the stock prices are going up so high that each time we're issuing new capital, you've got to raise more money because the stock is going for a higher price. So it's kind of just like, man, I don't know if I can think of a good example, but it's like, I don't know, man. It's like your credit card bill is so big, it's getting harder and harder to pay, and you're paying more and more interest. So you need to like maybe go and pay it with another credit card bill. Like that's not really a very good example, but it's just the price is getting higher and higher even to raise capital. And it's going to be really hard as the prices get higher. It's going to be cost more and more to sell the same number of stock. But the author here, Brett Jensen, finally says that after all of this, however, my belief is that none of these challenges listed above will be the ultimate trigger of the coming AI bust. More likely, the trigger of the next bear market following the AI boom will come from the credit markets. And that is what triggered the great financial crisis in 2008, which is what we've been talking about. In addition, credit-related collapses from Enron, WorldCom, and Global Crossing all occurred during the internet bust that ran from March 2000 to the market bottom in August 2002. And again, so Brett Jensen ultimately thinks that the credit markets are what is going to like fail this, which is kind of interesting because I mean, they're saying the credit markets are fail is really at the end of the day saying it's a cash problem, and so it's a combination of all the things we said above. But really, yeah, we're talking about cash crunch. Which domino comes to fall first? Who runs out of cash? If the revenues aren't there. If AI keeps taking off and businesses and individuals keep finding really great value in this and they keep paying, that's awesome. I'm just worried about these revenue projections sitting only 400 billion, and it says they are 800 billion short. That's going to be it. If the detriment is going to be if this revenue doesn't take off and it doesn't start covering this capex expenditures, and then if they can't pay the financing, then the credit markets stumble. Yeah, and then this whole little map just like comes down to pieces. So, anyways, this is not really like a projection of what's going to happen, but it shows this is a pretty good map of what it's going to take to go wrong and showing kind of where the holes are. So, all these companies competing for share in the AI market, all of them need to generate revenue to keep the fire in the furnace burning. And we'll see what happens. But let me know in the comments what you think is going to happen and your opinion on AI. I know it's a super hot topic and it's fun to talk about right now, but articles like this are super interesting. Again, if you want to check it out yourself, it's from Seeking Alpha. The AI market bubble will pop when, and it is by Brett Jensen.